Hello again, this is Mr. Liao, and this is the second part of the macro FRQ review. We're going to go over questions from the 2011 test version B and the 2018 test. Number one, assume that the economy of Meekland is in long-run equilibrium with a balanced government budget. A, using a correctly labeled graph of AS and AD, show the long-run aggregate supply and show the output level and the price level. So this is your garden variety long-run equilibrium position. LRAS intersects SRAS, which intersects AD at full employment, which is at YE, at a price level PLE. B, assuming consumer confidence falls, show on your graph in part A the short-run impact of the change in consumer confidence and label the new equilibrium price level and output Y1 and PL1 respectively. So decrease in consumer confidence means decrease in consumption, which causes AD to shift to the left, thereby lowering the price level and lowering the output level. C, using a correctly labeled graph of the short-run and long-run Phillips curves, show the effect of the fall in consumer confidence on inflation. Label the initial long-run equilibrium point A and the new short-run equilibrium point B. Phillips curve has unemployment rate on the x-axis, inflation rate on the y-axis. Long-run Phillips curve is vertical at NRU, downward sloping SRPC. Point A is where those two intersect. That's the long-run equilibrium point. Point B is going to be down the SRPC when there is a leftward or decreasing shift in AD. That's going to be movement down the SRPC. So equilibrium goes from point A to point B. D, if the government and the central bank do not pursue any discretionary policy change, how does the fall in consumer confidence affect government transfer payments in Meekland? Explain. So the transfer payments will increase because more people will apply for government benefits because of unemployment. We're seeing that now with the coronavirus crisis, that more people are losing work. They have to file for unemployment. Government's going to help fund unemployment payments for all these newly unemployed workers, and they've got to spend more to do it. So that's going to increase transfer payments to people in Meekland. E, draw a correctly labeled graph of the loanable funds market in Meekland and show the effect of the change in government payments you identified in part D on the real interest rate. Loanable funds graph has the quantity on the x-axis, real interest rate on the y-axis. There is your initial equilibrium. And due to the government borrowing more money, remember they started with a balanced budget, so they need to go to the loanable funds market to borrow more money to finance their transfer payments. So that's going to increase the demand for loanable funds, thereby increasing the real interest rate. F, in the absence of any changes in fiscal and monetary policies, in the long run, will the short-run aggregate supply curve shift to the left, shift to the right, or remain unchanged? So what's going to happen is SRS is going to shift to the right. Due to the AD going to the left, price levels are lower. So input costs are lower, wages are lower. Eventually, those lower costs are going to cause SRS to shift to the right to restore the long-run equilibrium. Number two, this is a foreign exchange problem, so if you want to skip it, you can because it's not going to be on the 2020 AP test. Assume that yesterday the exchange rate between the euro and Singaporean dollar was 1 euro per 0.58 Singaporean dollars. Assume that today the euro is trading at 1 euro for 0.60 Singaporean dollars. Part A1, how will the change in the exchange rate affect aggregate demand in Singapore in the short run? So the euro has appreciated in value. Yesterday it was worth 0.58 Singaporean dollars. Now it's 0.60. So it's appreciated in value relative to the Singaporean dollar. Because of that, Europeans are going to buy more Singaporean goods due to the stronger euro. So because of that, Singaporean exports will increase and AD will also increase. So what's going to happen is Singapore is going to benefit from the stronger euro because more Europeans are going to buy Singaporean goods. That's going to cause net exports to kick upward and AD will increase correspondingly. Part two, how will the change in the exchange rate affect level of employment in Singapore in the short run? Explains. So in part one, you said that AD increased, which means real output is increased. Since real output increases, employment is also increased because it takes more labor to produce those additional goods and services. Also, employment is directly related to real output. Part B, suppose that Singapore wants to return the exchange rate to €1 per 0.58 Singaporean dollars. Should the Singaporean central bank buy or sell euros in the foreign exchange market? So Singapore is enacting a fixed exchange rate scheme. For the euro to weaken, the demand for the euro must decrease and or the supply for the euro must increase. So the Singaporean bank should sell euros to increase the supply of euros. So they're going to sell euros. They can't demand fewer euros, but what they can do is flood the market with euros, thereby weakening the euro relative to the Singaporean dollar. This is why, to maintain a fixed exchange rate scheme, governments need to have a reserve of both currencies, the local currency, but also the currency that they want to peg their currency to, because they might need to lower the exchange rate, and the best way to do it is to flood the market with the other currency. Part B2, instead of buying or selling euros, what domestic open market operation can the Singaporean central bank use to achieve the same result? So the Singaporean central bank should sell government securities, and the reason is selling bonds will decrease the money supply, which will increase interest rates and thus causing capital flow to increase. If the capital flow to increase, inflow increases into Singapore, foreigners, or Europeans in this case, are going to want to invest in Singaporean financial assets, which is going to increase the European demand for the Singaporean dollar, thus strengthening the Singaporean dollar to make it stronger compared to the euro. Number 3, the outputs and prices of goods and services in country X are shown in the table above. Assume that 2009 is the base year. Assume each of the following. Part A1 is the national GDP in 2010. So what you're basically going to do is multiply in 2010 the quantity times the price for each of food, clothes, and entertainment. So you add them up, you get $145. Part A2, the real GDP in 2010. So you're going to use the 2010 quantities, but at the 2009 price. So 8 times $2.50 for food, 10 times $6 for clothes, 5 times $4 for entertainment. That's going to lead to a real GDP of $100. So basically, compared to 2009 prices, the real 2010 GDP is going to be $100. Part B, in one year the price index is 50, and the next year the price index is 55. What is the rate of inflation from one year to the next? So to go from 50 to 55, you want to look at the change in inflation, the change in the price index compared to the original price index. So the change is that the price index has gone up by 5. Divide that by the original price index, which is 50, which is 0.1 or 10%. Now, actually, this year on the AP test, you may use a calculator, even though historically you can't, but you can still expect the calculations to be somewhat straightforward. C, assume that next year's wages will be 3% higher than this year's because of inflationary expectations. The actual inflation rate is 4%. At the beginning of next year, will the real wage be higher, lower, or the same as today? Since actual inflation is higher than the increase in wage rate, next year's wages are actually going to have less purchasing power. So basically think of it this way. You've got a 3% raise, but prices are up 4%. So compared to what you're doing in the current year, even though you're making more money, what you can do with that money, what you can buy with that money is less than the previous year. So the real wage will actually be lower compared to the previous year. Finally, Part D, assume that Sara gets a fixed rate loan from a bank when the expected inflation rate is 3%. If the actual inflation rate turns out to be 4%, who benefits? So the expected inflation is 3, it turns out it's 4. Sara gets the benefit because her fixed loan payments, which she was paying at an anticipated inflation rate of 3%, is now worth less compared to 4%. So she's paying the same dollar amount, but the dollar amount she pays in terms of purchasing power is now less due to the actual inflation rate exceeding the anticipated inflation rate. 2018, number 1. Assume that the U.S. economy is in a recession. Gosh, you don't say. Part A, draw a correctly labeled graph of long run AS, short run AS, and AD curves showing each of the following: current price level, current output. So you have a recessionary gap because the question said you have a recessionary gap, which means your actual output level where AD intersects with the SRAS is below potential GDP, which is where LRAS is. So you can see indicated on the graph where the current price level and current output levels are. B, now assume that the Eurozone, a major trading partner of the U.S., also enters into a recession. B1, what will be the effect on United States exports to the Eurozone? So U.S. exports will decrease. The fall in income in the Eurozone reduces the demand for U.S. goods. So basically, the U.S. is going to export less to the Eurozone because the money in Europe is less. They're going to buy less stuff all around, including less U.S. goods, which means U.S. exports will decrease into Europe. On your graph in Part A, show the effect of the change identified in Part BI on real output in the United States. Since exports are going down, AD actually shifts to the left even more. So your price level goes further lower, and your output level goes even lower. Part 3, what will be the effect of the change identified in Part B2 on unemployment in the U.S.? You notice that real output goes down. Real output and unemployment are inversely related, so unemployment increases because real output is lower. C, assume the Eurozone recession causes a decrease in the demand for U.S. dollars in the Forex market. So again, not going to be on the 2020 AP test. Will the euro appreciate, depreciate, or remain unchanged against the dollar? Since the demand for U.S. dollars will decrease, that's going to cause the euro to increase. The decrease in demand for dollars means that the supply of euros in the foreign exchange market decreases, thus causing the ratio of dollars per euro to increase. So the euro appreciates. You can also think of it this way. Decrease in demand for dollars means that the dollar gets weaker. Since the dollar gets weaker, the euro has to get stronger. So either line of reasoning is fine. Part 2, draw a correctly labeled graph of the Forex market for dollars and show the effect of the decrease in the demand for dollars on the exchange rate for dollars. So now we're looking at the dollars. So there's your dollar. And the thing you want to look at is the y-axis is euros per dollar. The demand for dollars goes down, so the actual exchange rate for the dollar also goes down. D1, assume the U.S. implements a combination of expansionary fiscal and monetary policies in the absence of complete crowding out. What will be the effect of these policies on aggregate demand in the U.S.? So expansionary fiscal and monetary policies will both cause AD to increase. So remember, expansionary fiscal policy means increased government spending and or cutting taxes. Expansionary monetary policy means something that increases the money supply, thereby lowering interest rates, which causes consumption and investment to increase, which leads to AD increasing. D2, assume the U.S. implements a combination of expansionary fiscal and monetary policies. What will be the effect of the policies on the price level in the United States? So since AD increases, as we stated in Part D1, the price level will also increase. Part 3, what will be the effect of these policies on interest rates in the U.S.? So the effect turns out to be indeterminate because from a monetary policy standpoint, higher money supply, interest rates go down. Fiscal policy-wise, government spending goes up, demand for loanable funds goes up, which causes interest rates to go up. So you're not sure which direction interest rates ultimately go, even though one is nominal and one is real. You don't know which is the bigger policy. So whichever is the bigger policy will have a greater effect on the overall interest rate. Because we don't know that, the effect is indeterminate. Number 2, assume the economy of Land is currently at full employment. The government of Land reduces the tax rate on household interest earnings. Part A, what will happen to private savings in Land? So private savings will increase because of the lower tax rate on interest earnings. So now people are more willing to save their money because they won't have to pay as many taxes. Since they're willing to save their money, that's going to cause private savings to go up. Part B, draw a correctly labeled graph of the loanable funds market, show the effect of the change in private savings identified in Part A on the equilibrium interest rate. So you see the graph, real interest rate on the y-axis, loanable funds quantity on the x-axis, and we're told that private savings goes up. If private savings goes up, that means the supply of loanable funds also goes up, which means the real interest rate goes down. CI, given the real interest rate change identified in Part B, what is the short-run effect on aggregate demand? So the interest rates have gone down, which means consumption and investment will also go up, which means aggregate demand will go up. 2, given the real interest rate change in Part B, what's the long-run effect on potential real gross domestic product in Land? Explain. So potential real GDP will increase because investment spending will increase due to the lower interest rates. There's going to be a larger investment in capital stock, which is going to lead to long-run economic growth. Long-run economic growth means LRAS eventually increases, thereby increasing the level of potential real GDP. Number 3, countries face trade-offs between producing consumer goods and producing capital goods. Country X takes 1 hour to produce a unit of consumer goods and 2 hours to produce a unit of capital goods. Yes, it's a comparative advantage problem. Country Y takes 2 hours to produce a unit of consumer goods and 4 hours to produce a unit of capital goods. Which country has the comparative advantage of the production of consumer goods? So it's probably helpful to make a chart. So we told X takes 1 hour to produce 1 unit of consumer goods, takes 2 hours to produce 1 unit of capital goods. For Y takes 2 hours to produce a unit of consumer goods and 4 hours to produce a unit of capital goods. So this is an input, which means input means other goes under. So for consumer goods, for X, the opportunity cost is 1/2 of a capital good. For group Y, or for country Y, it's still 1/2 of a capital good to produce 1 consumer good. So it turns out the opportunity costs are the same. Since opportunity costs are the same, neither country has comparative advantage in the production of consumer goods. That's a tricky question. They never actually tested such that it's a tie. When it's a test, it just means neither country has the comparative advantage. B, calculate the unemployment rate in country X. Show your work. So first, you need to figure out the number of unemployed divided by those in the labor force. The labor force is 180,000. Those are the people that are employed, plus all the people that are unemployed, not just frictionally employed and structurally employed, but also cyclically employed. So you got to add in those 10,000 plus 5,000 plus 5,000, give you 200,000 total people in the labor force. The 100,000 that are not in the labor force, who cares? So the total unemployed are the frictionally, structurally, and cyclically unemployed, which is 20,000. 20,000 over 200,000 represents the unemployment rate, which is 10%, which seems pretty good these days because when unemployment rate is soaring. Part C, calculate the labor force participation rate in country X. Show your work. Now we care about the labor force participation rate. We know that 200,000 people are in the labor force from our calculations in Part B. We know that 100,000 people are not in the labor force, which means the total population is the 200,000 that are in the labor force plus the 100,000 that aren't, which is 300,000, which means the labor force participation rate is 200,000 over 300,000, or 66 2/3%. Finally, Part D, draw a correctly labeled graph of the PPC for country X with consumer goods on the horizontal axis and capital goods on the vertical axis. Indicate a point on your graph labeled Z that reflects the current level of employment. So consumer goods on the X-axis, capital goods on the Y-axis, and 10% is a pretty high rate of unemployment, which suggests that there is an underutilization of resources. Remember, in our world, 5% is generally full employment, which means 10% is very high, which means point Z is going to be somewhere inside the PPC. So that's it for these 2 years' questions. If you have any questions, you're welcome to ask me anytime.